do you do when your credit card payments are $700? What do we do about that? If you all have not watched my playlist where it talks about credit card debt strategies, if you're having problems with credit cards, please go watch those videos because they will give you ideas that maybe you've not thought of before with helping you with those credit card payments. Another thing is if you have a really low credit score, and you have credit cards, try making multiple payments throughout the week and the month. That will help to boost your credit score. Now, what does that mean? If you have a $400 payment due, say on the due date for any credit card, if you take and break that down into $100 increments for the 4 weeks, so $100 each week, that will help you. But if you even go one step further and knock that down to $25 5 times a week, to where you put in multiple small payments throughout the week and the month, that will do wonders for your credit score. At least everybody I've worked with that we've done that, it has caused your credit scores to really boost. So multiple payments throughout the week is wonderful on credit card debt. That will reduce your interest charges. That has been known to boost credit scores 40 to 90 points by the next reporting date. So keep little thoughts like that in mind. And if you have a big payment, like this one is a $700 payment on a Chase. If they were to break this up into multiple payments throughout the month, it can boost their credit score. But that $700, if they're using these credit cards for an expense card, what does that mean? Again, the playlist with credit card debt strategies will show that to you line by line, giving you exacts on how to break down your expenses and put them into a credit card. What happens when we put income into a credit card? Let me see if you all can see this board. And if you can, I'm going to do a quick example to give you guys an idea if you haven't tried this already on your own. Now, 700 for your credit card payment, like this one is. If they have, let's say their food is 500 a month, and let's say their gas is 200 a month, that's 700, right? If they take 700 and put into this credit card, this 700 for their food and their gas is practically and is satisfying this payment. So when you put in the 700 just to cover your food and gas, you are satisfying the $700 payment that was to be made for this month. So they would then turn around and spend their 500 and their 200 on gas throughout the month. Now this 700 payment has become cash flow. So if you are in trouble with your credit cards, and let's say you have 2, 3, 4, 5 credit cards, if you can break down your expenses like this for each credit card, put your electric bill on one, put your cable bill on another, whatever you can cover in the month to take care of some kind of bill, utility, whatever, gas, food, like I said. I have my alarm system on one. Anything that you have that's chargeable, if you will put your income into the credit card to cover the expense, then this is satisfying the payment as that income goes into the credit card, and it's giving you kind of a break. It's allowing you to have a break because you're actually funding these credit cards. You may be bringing the balance down on a credit card, especially if you have $2,000 in expenses. It goes into this credit card. That's going to drop your balance, right? The $2,000. Throughout the month, it will come back up as you're charging the expense out. But you've satisfied this payment, turning that into cash flow. Now this is just having the little bit of interest come out that may, depending on what the balance of that credit card is. Remember, the banks charge an average daily balance when it comes to how they charge on that interest rate. The lower we can get that balance every day, the better off you're going to be with your interest charges. Remember, too, you will want to do this in multiple payments. So if you're going to do $25, $50 payments, every day, every other day, that's going to help boost your credit score. What's the difference between a HELOC loan and an automated payment system? Those are nothing. Those aren't even the same thing. So we're definitely going to go over that. First of all, your phrase there, HELOC loan. No such thing. It's either a home equity line of credit or it's a home equity loan. Two different animals. Remember, the lines of credit are the little kitty cat, and the loans are the big mean lion. Two totally different animals. The automated payment system is something that helps you pay off debt. So that is nothing to do with a loan or a line. We will go over that more. Do you also do this for personal loan? Apply any windfalls to it? No, no. Loans are not lines. We cannot reuse them. A loan is an amortized schedule. Okay. So if you're talking about a loan, this is an amortized schedule, meaning if your first payment is $500, then your second payment will be $500. Your third payment will be $500. You will pay $500 until you have paid that loan off in full. That is an amortization schedule. This interest is ridiculous. Okay. Why is it ridiculous? Because if this is a 30-year loan, guess what? All of your interest is going to be front loaded in your first 7 years. That's why mortgages will rob you if you are not handling them correctly. Okay. This is why I am so against loans, is because this 30 years is front loaded to 7 years. Every payment that you're making in the first 7 years is mostly interest. Okay. The line of credit is not like that. The line of credit is revolving. So let's talk about the line and why they are so perfect for us. A line of credit. If you are approved for $10,000, they're going to tell you you have a $10,000 limit. Remember, this is a line, not a loan. We don't do loans, only lines. So $10,000, and if you use 5,000, you now have 5,000 still available to you. Okay. So if your balance is $5,000, then you make $5,000 a month in income. When your income goes in, this is what happens. You have started completely over. And now, because this is a line, it is revolving. That means that your income went in. Now you can pay your expenses out. So let's say that you have $4,000 in expenses every month. You're going to pay those throughout the month. Your interest is charged on the average daily balance. That means that if you have $100 come out for a meal today, and you have $50 come out for gas tomorrow, and you have $100 for your internet come out the next day, you're just up to $250. Even though you have $4,000 in expenses that are going to come out throughout the month, the bank is going to figure your interest charge only based on what your average daily balance is. Meaning if it's $250 one day and it's $4,000 the next, you're averaging that, right? So if you average that, that means $4,250 divided by 2. That's $2,125 would be your average daily balance. Then your interest, and I don't care if this is 18%, times 18% divided by 12 for the months, $32 would be all the interest that you would pay on this account for 1 month. It's very important that you understand that the line of credit is a wonderful tool because it allows us to use the money and put it right back in so that we're not paying a lot of interest like you are on a loan. That loan is going to get you every time. The line is something you can control. If you're using it correctly, you're going to win every time when it comes to paying off your debt. Okay.